Ever wonder how stock traders predict the market trends and make their investment decisions? The secret lies in chart patterns. Chart patterns, my friends, are the heart and soul of technical analysis in stock trading. They're like the tea leaves of the financial world, allowing traders to gaze into the future of market trends. It's a fascinating world of peaks, valleys, breakouts, and breakdowns, all speaking a language that traders must learn to understand. These patterns are formed over time as the price of a stock rises and falls. And here's the kicker: they often repeat themselves. This repetition is what allows traders to anticipate what's coming next. By recognizing these patterns, traders can make educated guesses about future price movements, helping them make profitable trades. So, are you ready to delve into the world of chart patterns? It's a world where art meets science, where intuition meets evidence, and where the savvy trader meets success. Chart patterns are like the footprints of market psychology. They come in different forms, each with its unique significance. Stepping into the realm of chart patterns, one might be overwhelmed by the plethora of shapes and structures. But don't fret. Each pattern is a key to unlocking potential market trends, and understanding them can be your secret weapon in trading. First off, let's talk about head and shoulders. This pattern, much like the name suggests, resembles a head with two shoulders. It's a bearish pattern that indicates a potential reversal of an uptrend. The formation of a head between two shoulders suggests that the market is gearing up to shift from bullish to bearish. So, if you spot a head and shoulders pattern, it might be time to consider selling. Next up, we have the double top and bottom patterns. These are like mirror images of each other. A double top is formed when the price reaches a particular high point twice, but fails to break through, indicating a bearish reversal. On the flip side, a double bottom occurs when the price hits a certain low point twice, but can't push further down, suggesting a bullish reversal. Spotting these patterns could mean it's time to buy or sell, depending on the market's direction. Moving on, let's explore triangles. Triangles can be ascending, descending, or symmetrical. These patterns are formed when the price consolidates between support and resistance levels before breaking out. An ascending triangle is characterized by a flat top and rising bottoms, indicating bullish momentum. A descending triangle, conversely, has a flat bottom and falling tops, suggesting bearish momentum. Symmetrical triangles, with their converging trend lines, indicate that the market is undecided and a breakout could occur in either direction. Flags and pennants are short-term continuation patterns that indicate a pause in the trend before it resumes in its original direction. A flag looks like a rectangle sloping against the prevailing trend, while a pennant resembles a small symmetrical triangle. Remember, these patterns are usually seen after a sharp price movement and suggest that the trend is likely to continue once the pattern is complete. Finally, let's discuss cup and handle. This pattern resembles a teacup with a handle on the right side. It's a bullish continuation pattern where the cup is formed by a round bottom representing a period of consolidation, and the handle is a smaller pullback before the price breaks out to continue the uptrend. In essence, these chart patterns are the language of the markets. They tell a story of the ongoing battle between supply and demand, bulls and bears. Understanding these patterns is more than just recognizing shapes on a chart. It's about deciphering the market's mood, anticipating its next move, and making informed trading decisions. Understanding these patterns can be your first step towards successful trading. So buckle up and let's dive deeper into the world of chart patterns. Now that you know the types of chart patterns, you might be wondering, how do you use them in trading? Great question, and that's exactly what we're going to delve into right now. Chart patterns are like the compass and map of the financial markets. They guide traders through the volatile seas of stocks, currencies, commodities, and more. So, how exactly do they do that? Well, it's all about predicting future market trends. Think of chart patterns as the footprints left behind by market action. They show us where the market has been, and more importantly, give us clues about where it might be heading next. When traders spot a certain pattern forming, they can make educated guesses about the future price movement. Will it go up? Will it go down? Or will it continue to move sideways? The answers to these questions lie within the patterns on the chart. Now, let's talk about one of the key concepts in trading with chart patterns, the breakout. Picture this, you're looking at a chart pattern, say a symmetrical triangle. This pattern is formed by two converging trend lines, one ascending and one descending, meeting at a point called the apex. You notice the price bouncing between these trend lines, creating higher lows and lower highs. The tension is building like a coiled spring. Then suddenly, the price breaks out of the pattern, either above the resistance line or below the support line. This is the breakout, the moment the market decides its next direction. It's like the spring uncoiling, releasing all that pent-up energy in one direction. Traders use this breakout as a signal to enter or exit a trade. If the price breaks above the resistance line, it's a bullish signal, indicating it might be a good time to buy. Conversely, if the price breaks below the support line, it's a bearish signal, suggesting it could be time to sell or short. However, it's important to remember that trading is not an exact science. While chart patterns can provide valuable insights, they are not foolproof. They are just one tool in a trader's toolbox. Other factors, such as volume, indicators, and market news, should also be considered before making a trading decision. So, there you have it. That's how traders use chart patterns to navigate the financial markets. They interpret the patterns to predict future trends, watch for breakouts to decide when to enter or exit a trade, and combine this information with other market data to make the best possible trading decisions. With chart patterns, you have a powerful tool to navigate the volatile waves of the market. Now, let's move on to the next scene where we'll discuss the importance of these patterns in trading. Stay tuned. Why do chart patterns matter in trading? The answer is simple. They provide valuable insights into market trends. Chart patterns are the lifeblood of technical traders. They serve as a visual representation of the buyer and seller psychology, reflecting the push and pull of different market forces. As traders, we're not just looking at numbers and lines on a chart. We're peering into the collective mind of the market, seeing the fear, the greed, the hope, and the despair that drives price movements. But chart patterns do more than just reflect market psychology. They also help predict future price movements. By identifying these patterns, traders can forecast where a stock's price might go next. This predictive power gives traders a significant edge in the market, allowing them to make informed decisions and potentially reap substantial profits. Consider the head and shoulders pattern, a classic example of a reversal pattern. This pattern signals that a stock's price is likely to move against the current trend. By recognizing this pattern, a trader can prepare for a potential market reversal and adjust their trading strategy accordingly. This could mean exiting a long position before the price drops or entering a short position to profit from the expected downward move. Similarly, the double bottom pattern, a bullish reversal pattern, signals that a stock's price is likely to rise after hitting a certain low point twice. Recognizing this pattern allows traders to capitalize on the upcoming uptrend by entering a long position at the right time. So, you see, chart patterns aren't just pretty designs on a screen. They are essential tools for reading the market and making strategic trading decisions. They allow traders to cut through the noise and chaos of the market, providing a clear visual guide to the underlying trends and forces at play. And that's why chart patterns are so important in trading. They don't just help us understand what's happening in the market now. They also give us a glimpse into what might happen next. They are, in a way, the trader's crystal ball, offering valuable insights into future price movements. Chart patterns are like a roadmap, guiding traders through the complex world of stock trading. Let's recap what we've learned about chart patterns. These are the graphical representations of market movements, the heartbeats of the economy, if you will. We've discussed the various types, from head and shoulders to double tops and bottoms, each with their own unique message. Remember, the triangle pattern is like a coiled spring indicating potential breakouts, while the cup and handle, well, it's like a tea party invitation for traders, signaling a bullish trend. We've also delved into how traders use these patterns. They're not mere doodles on a chart. They're tools for making informed decisions. They help traders predict potential price movements, acting as a weather forecast for the financial market. And we've emphasized their importance in trading. They're not optional, they're essential. They provide valuable insights into market psychology, giving traders a peek into the collective mind of the market. So, next time you see a chart pattern, remember it's not just a pattern. It's a story of the market, waiting to be read.